Hello, and welcome to the Deep Dives, your shortcut to being well-informed. Today, we're diving deep into a topic that sits right at the cutting edge of global finance and ancient wisdom. The fascinating and often complex intersection of cryptocurrency and Islamic finance. You've sent us a stack of compelling articles and research, and our mission today is, well, to distill the most important nuggets of knowledge from these sources. We'll help you navigate this complex landscape of digital assets through the lens of Sharia principles, exploring everything from what cryptocurrencies truly are to how they're viewed by Islamic scholars, the inherent risks, and even how the Zakat applies to your digital holdings. There's a lot to uncover, so let's get started.
Absolutely. And what's truly fascinating here, as you said, is how a disruptive technology like blockchain and, the digital assets it underpins forces us to re-examine fundamental questions within centuries-old legal and financial principles. Our sources immediately highlight a clear division among scholars. It's quite striking.
Yeah, that definitely jumped out.
And we're going to delve into why there isn't yet a single universally accepted fatwa or religious ruling on crypto. It's a powerful testament, really, to the dynamic nature of both technology and Islamic jurisprudence, constantly adapting to new realities while holding firm to its core tenets. This isn't just about technical definitions, it's about a profound philosophical and legal debate.
Okay, so before we get tangled in the Sharia complexities, let's just, level set. We really need to understand what this technology is. Our sources lay out the basics quite well. So for you listening, what exactly is a cryptocurrency coin? How is it different from the digital money maybe already in your online bank account?
Right, that's a key distinction. So at its core, a cryptocurrency coin is a digital asset. But the crucial part is it operates on its own unique blockchain network. Think of Bitcoin, for example. It functions exclusively via the Bitcoin blockchain. It's not just numbers in a bank's database.
Right.
It's fundamentally a digital token, and it's secured by advanced cryptographic techniques. This is for highly secure and verifiable data transmission. And unlike, say, the balance in your online bank account, which is really just a digital representation of physical fiat currency held by a central institution.
Right, like dollars or euros.
Exactly. A cryptocurrency doesn't have a physical form at all. It exists purely as entries on a distributed ledger, verified and maintained by a network of computers all around the world. So this distinction existing on its own decentralized network, secured by cryptography, is absolutely crucial.
That's a critical point. It's not just digital money. It's something fundamentally different in structure. Now, there's this really insightful analogy in one of the articles comparing crypto to casino chips or theme park tokens. Can you unpack that a bit? It seems helpful for grasping the value concept.
Yes, it's a very useful comparison, I think. The source suggests thinking of cryptocurrency like a casino chip, or maybe those tokens you buy at an amusement park. Imagine those plastic tokens, right? You buy them for rides, or the chips you use at a roulette table.
In themselves, those physical tokens are, let's be honest, intrinsically worthless. The plastic or composite material has basically no inherent value.
Right.
But they gain value within a very specific context or network. Inside that theme park or within that casino, they are accepted as currency for their intended purpose. Their value comes from the agreement and the acceptance within that closed system.
Okay, so the value isn't inherent in the thing itself, but in the agreement to use it.
Precisely. And similarly, with cryptocurrencies, their value isn't tied to a physical commodity like gold, nor is it directly backed by a central government guarantee like, say, the US dollar. Instead, it gains value because enough people within its network agree to accept it, either as a medium of exchange or maybe as a store of value.
So the more people join in. Exactly. The more people who join a cryptocurrency's network, the more widely accepted it becomes as a tradable asset, and consequently, the more value that specific coin acquires. It's a really powerful demonstration of a network effect in action. Collective belief and utility kind of imbue something with value. And this concept of value, derived from collective acceptance rather than intrinsic backing, is precisely where many of the Islamic finance questions really start to bite.
That network effect is powerful stuff. But okay, beyond that, what makes cryptocurrencies truly distinct? Our sources highlight some really unique characteristics that fundamentally shift how we think about money, don't they?
Yeah.
There's an article that delves into these traits specifically.
Absolutely. And these aren't just minor technical features. They have profound implications for how these assets behave and, crucially for our discussion, how they're viewed through the lens of Islamic finance. So, first up, there's transparency.
Right.
Yeah.
The public ledger idea.
Exactly. Every single transaction made using most cryptocurrencies is recorded on a public blockchain ledger. And this ledger is immutable, meaning it can't be easily changed, and it's accessible to anyone, anywhere in the world with an internet connection. The idea here is to drastically reduce fraud and build trust, because every transfer can theoretically be verified independently.
Like with Bitcoin, you can see the whole history.
Precisely. The entire history of every transaction is permanently visible. Now, this inherent transparency isn't just a technical feature. You could argue it aligns quite well with Islamic principles of accountability and trust. It's almost like a built-in mechanism against deception.
Okay, transparency. What's next?
Then there's pseudonymity. This might sound like it contradicts transparency, but they actually coexist in a sort of interesting way. While the transactions themselves are public, the actual real-world identities of the users behind those transactions are typically hidden behind these complex cryptographic addresses. Think of them like digital PO boxes.
So you see the transaction, but not necessarily who made it.
Generally, yes. It offers a certain level of privacy, allowing users to maintain a degree of anonymity. However, as our source points out, this characteristic also presents significant challenges. Challenges for regulatory compliance, for preventing illicit activities like money laundering or terrorist financing.
Yeah, I can see that.
And we have seen, unfortunately, privacy-focused coins like Monero and Zcash being used for such purposes because they make tracing even harder. So it's genuinely a double-edged sword. Privacy for legitimate users, but also a potential shield for illicit activity.
Okay, transparency and pseudonymity. What else?
Next, we have decentralization. And this is arguably the cornerstone, the most revolutionary aspect of cryptocurrency.
No central bank, no single point of control.
Exactly. Unlike traditional financial systems controlled by central banks, governments, or large corporations, cryptocurrencies operate on a decentralized network of computers spread across the globe. This design ensures that no single entity has ultimate control over the currency's issuance, its validation, or the movement of funds. This makes it remarkably resistant to censorship and manipulation by any single authority.
Like with Ethereum, right. It allows for these decentralized apps.
Precisely. Ethereum is a great example. It's a blockchain platform that enables the development of decentralized applications, or dApps. These allow individuals to create and interact with digital assets and services without relying on traditional intermediaries like banks or brokers. And this inherent resistance to central control, well, it resonates with certain Islamic finance ideals about empowering individuals and communities over potentially exploitative centralized systems.
Interesting connection. What else defines crypto?
Programmability. This is another key trait, and it's truly revolutionary in its implications. This enables what are known as smart contracts.
Ah, yes, I've heard about these. Contracts written in code.
That's right. They are self-executing agreements where the rules of the agreement are written directly into lines of code. And these are deployed on certain blockchain platforms, again, like Ethereum. What's incredible is that once the conditions specified in the code are met, say a payment is received or a deadline passes, the contract automatically executes the agreed-upon actions without needing any third-party intermediary, like a lawyer or escrow agent.
Wow, okay.
This allows for automated transactions and the creation of highly complex decentralized applications with predefined rules. Think about decentralized finance, or DeFi. Smart contracts are the backbone, facilitating lending, borrowing, trading, all without traditional banks. It fundamentally reshapes how financial services can operate. And potentially, this automation could offer models that inherently reduce transactional uncertainty, or Gharar, by automating clear, predefined terms.
That's a huge potential benefit. And the last characteristic.
Finally, there's global accessibility. Cryptocurrencies offer an alternative for potentially billions of individuals worldwide who might not have access to traditional banking services.
The unbanked population.
Exactly. Or people living in countries with unstable economies, or perhaps restrictive financial controls. Anyone with an internet connection and a compatible device, like a smartphone, can potentially participate in this digital economy regardless of their location or socioeconomic status.
That's powerful.
It really is. This broad accessibility has the potential to promote significant financial inclusion in underserved regions. There are projects like Stellar, for instance, specifically aiming to facilitate low-cost, fast cross-border transactions and provide affordable remittance services to individuals in developing countries. So, you see, these characteristics, transparency, pseudonymity, decentralization, programmability, and accessibility, aren't just technical details. They have profound implications for how finance operates globally and, critically, how it might align or clash with Islamic finance's ethical mandate for inclusion, justice, and clarity.
Okay, that's a fantastic overview of the what. Now let's pivot to the core question for this deep dive, the Islamic finance perspective. A fundamental concept our sources keep bringing up is Maul. Why is this term so critical?
Maul is absolutely central. You simply can't discuss the permissibility of crypto and Islamic finance without understanding Maul. It literally translates to wealth, property, or anything that has value and can be possessed or acquired. It's a foundational concept in Islamic jurisprudence, particularly contract law.
So for a transaction to be valid,
For a transaction like a sale or a lease to be valid under Islamic law, what is being exchanged must generally qualify as Maul. One of the sources puts it succinctly: an accepted definition of transaction is an exchange of Maul in consideration of Maul.
okay, Maul for Maul.
Exactly. If what's being exchanged on one or both sides isn't considered Maul, the contract itself can be rendered void or batil. Now, Maul can be corporeal, a physical thing like a car, a house, grain, or it can be usufruct, which is the right to benefit from something, like the right to live in a rented apartment.
So how does Islamic law define what counts as Maul? Is it just anything people value?
Not quite that simple. Different schools of Islamic law have slightly nuanced definitions, but a key one comes from the Hanafi school. They define Maul as what is normally desired by people and can be stored up for the time of need.
Desired and storable.
Yes. Desired generally means it has utility or value in the eyes of people, not just something fanciful. Storable implies it can be possessed, controlled, and saved for future use. So things like, say, birds flying freely in the sky, or a pleasant scent just drifting by, or even a fleeting thought. These generally aren't considered Maul because you can't really possess or effectively store them.
Makes sense.
And this definition immediately raises the crucial question for our topic. Do cryptocurrencies, these purely digital entries on a distributed ledger, constitute Maul? Can they be truly possessed or stored in a way that satisfies the classical definitions? They aren't physical. They don't exist in a vault.
Right, they exist as data.
Exactly. And this is precisely where the core debate begins among Islamic scholars. It's pushing the boundaries of centuries-old definitions to grapple with these new technological realities. The debate isn't just academic, it's about whether the very foundation of crypto transactions is valid under Sharia.
So given that challenge, how are scholars actually approaching this? You mentioned a spectrum of views. Can you walk us through the main positions?
Absolutely. The sources outline three main fiqhi, that's Islamic legal positions that scholars have taken, and it really is quite a spectrum. The first position is perhaps the most critical. It holds that cryptocurrency is not Maul and is purely speculative, and therefore it's fundamentally non-Sharia compliant, or haram. The argument here is that because crypto lacks physical form, lacks backing by a tangible asset or central authority, and its value is seen as purely driven by speculation, it cannot meet the criteria for Maul.
Okay, so a complete rejection based on the definition of Maul.
Yes. However, one of our sources, the Islamic Finance Guru article, pushes back quite strongly against this view, actually calling it wrong.
Why?
Their reasoning is based on observable reality. They argue that cryptocurrencies clearly do have value to the millions who buy them and to the growing number of businesses that accept them as payment. Value, they argue, ultimately derives from the meaning and utility we imbue into things. If a large enough community values Bitcoin and uses it, then it is valuable and functions like Maul in practice, much like fiat currency, which, post-gold standard, is also not intrinsically backed but is universally accepted as Maul due to government decree and social convention, ERF.
So focusing more on function and social acceptance than physical form.
Exactly. Now, the second position is a bit more nuanced. It suggests that cryptocurrency is a digital asset, but it's not currency. This view is described in one source as probably about right at this moment in time. It was also the initial conclusion of a prominent scholar, Mufti Faraz Adam, after extensive research.
So it acknowledges its value, but not as money.
Precisely. This position recognizes that crypto clearly exists, it has market value, it can be owned and traded so it qualifies as a type of asset, maybe like a digital commodity or collectible. But it stops short of calling it true currency in the Islamic sense. Why? Because the definition of currency in Islamic finance often requires more stability, wider acceptance as a unit of account, and effectiveness as a medium of exchange for everyday transactions. And crypto, well.
It's generally too volatile for that right now.
Exactly. This distinction between asset and currency is important because the specific rules in Islamic finance can differ, especially regarding things like Zakat calculation or rules around lending and exchange.
Okay, so asset yes, currency no yet. What's the third view?
The third position is the most permissive. It argues that certain kinds of cryptocurrency are actually currency. Now, the source calls this view a bit punchy given the current state of the crypto market.
Meaning maybe a bit ahead of its time.
Perhaps. The main argument against classifying most current cryptos as currency comes down to their functional limitations. A true currency, from an Islamic perspective, needs to be relatively stable, allow for instantaneous or near-instantaneous execution of transactions, and have low, predictable costs to facilitate fair and reliable exchanges in daily life. Cryptocurrencies, as we know them today, often fall short. They can experience severe price crashes. They're susceptible to large-scale online heists. Their value can fluctuate wildly, making them a poor unit of account.
And the transaction fees can spike unpredictably too, right?
Exactly. During times of high network congestion, transaction costs can surge dramatically, and processing times can become frustratingly long. These characteristics mean they don't yet function as an effective, stable, and reliable means of payment that a true currency requires.
But is that door completely closed? Could they become currency later?
The source definitely leaves that door open. It notes that this classification isn't necessarily static. If, and it's a significant if, a cryptocurrency emerges from this, let's call it developmental phase.
Matures a bit.
Right. If it gains widespread credence and acceptance because it becomes genuinely secure, consistently quick, reliably low cost in its transactions, and highly stable in value, then yes, it absolutely could sit alongside traditional fiat money as a legitimate currency from a Sharia perspective. So the potential is there, contingent on technological evolution and market maturity, fundamentally changing its practical characteristics.
That really lays out the different ways scholars are thinking about the fundamental nature of crypto. Now let's get into specifics. Our sources mention particular scholars and their reasoning. Can you highlight some of the key figures on both sides of the halal-haram debate?
Yes, naming specific scholars and understanding their reasoning is crucial because it shows the depth and basis of the disagreement. It's not just arbitrary opinion. So, on the side arguing that crypto is haram, impermissible, a very prominent voice is the Grand Mufti of Egypt, Sheikh Shaki Elam. His reasoning focuses heavily on the concepts of uncertainty, Gharar, risk, and the potential for fraud. He points to several factors: the lack of deep systemic control or regulation, its detachment from established markets or national economies, its inherent instability and high volatility, and also the complex technical knowledge needed just to store it safely to prevent theft or loss. He sees these factors combining to create an unacceptable level of risk and ambiguity.
So the practical risks and lack of oversight are key for him.
Exactly. Another influential scholar holding this view is Sheikh Haytham al-Haddad. His argument is slightly different, focusing more on the idea of intrinsic value. He argues that Bitcoin is impermissible primarily because it's a currency not based on any real, tangible value. Now, interestingly, he extends this critique even to modern fiat currencies after the end of the gold standard in 1971, arguing they also lack true intrinsic value.
That's a broader critique of modern money itself.
It is. But his specific issue with Bitcoin, compared to fiat, is that it additionally lacks any backing authority, like a government, and isn't stable. Crucially, he also argues there's no overriding necessity, darura, for people to use it in daily life, unlike state-issued currency. So for him, it's the combination of lacking intrinsic value, lacking authority, being unstable, and not being necessary that renders it haram.
Does he see any possibility for a crypto to be halal?
He does leave a specific door open. He explicitly states that a cryptocurrency directly and fully backed by gold could potentially be considered halal. This suggests his primary concern is the value from nothing aspect. And as a consequence of viewing Bitcoin as creating value from nothing, he also deems Bitcoin mining to be impermissible.
Okay, those are strong arguments focusing on risk, value, and authority. What about the scholars who lean towards permissibility, arguing that crypto is halal?
On this side, we have figures like Mufti Faraz Adam and Mufti Muhammad Abu Bakr. Their arguments often center more on the practical realities of market acceptance and utility. Mufti Muhammad Abu Bakr, for example, views Bitcoin as generally permissible. Why? Because it's clearly perceived as something valuable by the market. People are willing to pay significant sums for it. It's readily available on major exchanges. And importantly, it is being accepted as a medium of payment by a growing number of platforms and vendors.
So if it functions like valuable property in the real world, it should be treated as such.
That's essentially the argument. If it has recognized value, malia, and utility, manfa, it can be considered mal and thus permissible to trade. However, Mufti Muhammad doesn't give it a completely free pass.
He adds a caution.
Yes, a very important prudential note. He advises caution due to the industry still being quite new, its well-known price volatility, and the very real risk of significant financial loss. So, permissible, yes, but invest wisely and be aware of the risks.
Any other scholars on the halal side?
Another notable voice is Ziad Muhammad, who chaired the Sharia Committee for HSBC Amana Malaysia. His argument tackles the intrinsic value point head-on. He argues that Sharia doesn't strictly require a currency or asset to have intrinsic value in the way Sheikh Haytham might define it. What's fundamentally important, in his view, is social acceptance, qabul, that people collectively agree it has value and its practical usability for transactions.
So more emphasis on social convention again.
Precisely. He concludes with cautious optimism about crypto's potential, especially if its current issues like volatility and regulatory ambiguity are addressed over time. However, he also adds a condition related to market behavior. He cautions that if cryptocurrencies like Bitcoin become excessively volatile, driven mainly by irrational retail investing and purely speculative bubbles, then trading in them could become questionable from an ethical investment standpoint, even if the asset itself isn't inherently haram. The manner of trading matters.
It's fascinating how different scholars weigh these factors: intrinsic value versus social acceptance, potential utility versus current risk. No wonder there's disagreement. That Reddit thread you mentioned earlier really captures the user frustration with this lack of clarity.
It really does. You see people asking, why can't we just get a straight answer? Some users speculate, perhaps rightly, that maybe some scholars giving opinions don't fully grasp the complex technology or the nuances of the financial systems underpinning crypto.
Or maybe older rulings are just outdated now, given how fast things change.
That's another point raised. The crypto space evolves incredibly quickly. An opinion from 5 years ago might not fully capture the current reality of institutional adoption or regulatory developments.
But this disagreement itself,
Yeah.
is that unusual in Islamic law? Or is it normal to have differing opinions?
That's a crucial point. The existence of differing opinions, ikhtilaf, is actually very common and, in many ways, a sign of dynamism within Islamic jurisprudence. Think about the different established schools of thought, the madhabs, Hanafi, Maliki, Shafi'i, Hanbali. They often have different rulings on various matters based on their different methodologies, usul al-fi, for interpreting the primary sources, the Quran and Sunnah.
So disagreement doesn't automatically mean something is wrong or forbidden?
Not necessarily. It reflects the process of ijtihad, independent reasoning by qualified scholars applying timeless principles to new situations. Different scholars might prioritize different legal maxims or weigh evidence differently. One user on that Reddit thread made a compelling point. We don't deem fiat currency haram just because it can be used for illicit activities. So applying that standard only to crypto might seem inconsistent to some. It highlights these methodological differences.
So what does this mean for you, the individual Muslim trying to navigate this? If scholars disagree, how do you decide?
That's the practical challenge. Some argue that if you've done your research, understand the arguments, and find the reasoning for permissibility convincing according to your understanding and conscience, then the mere existence of other opinions doesn't automatically make it doubtful for you. However, others invoke the famous hadith prophetic tradition about avoiding doubtful matters, shubuhat. This principle advises that if you remain genuinely unsure, confused, or uneasy after considering the differing views, then perhaps piety suggests steering clear to protect your faith and finances.
So it comes down to personal conviction and diligence.
To a large extent, yes. It places a burden of seeking knowledge and forming a reasoned conclusion on the individual, always respecting the scholarship on all sides.
But are institutions doing anything to bridge this gap, maybe provide more informed guidance?
Yes, and this is a really positive development highlighted in the sources. We're seeing institutions actively trying to address this knowledge gap and provide clearer pathways. For example, the Sharia Review Bureau, SRB, in Bahrain is mentioned specifically because they have scholars on their board who also hold computer science degrees.
Ah, So they understand both the Sharia and the tech.
Exactly. This allows them to deeply understand the underlying technology, the code, the network mechanics, enabling them to issue more informed and robust Sharia certifications for crypto projects or platforms. We also see major blockchain networks themselves, like Algorand and Stellar, having previously hired dedicated Sharia advisors. Their goal was to ensure their protocols and tokens were designed and operated in a Sharia-compliant manner right from the start.
That's proactive.
Very much so. And several leading crypto exchanges operating in Muslim-majority regions like CoinMena and Rain have established their own dedicated Sharia boards. These boards vet the listed assets and provide guidance to users, aiming to offer a compliant trading environment. These efforts within the industry and by specialized advisory firms are crucial for building trust and providing the clearer guidance that users are seeking. It's helping to move the conversation forward practically.
That's encouraging. Now, you mentioned earlier that one of the core concerns for scholars ruling crypto as haram is Gharar. Let's unpack that concept because it seems central. What exactly is Gharar?
Gharar is a really critical concept in Islamic finance, and yes, it's absolutely central to the crypto debate. It's an Arabic term that essentially means uncertainty, ambiguity, or excessive risk within a contract or transaction. It specifically refers to situations where key elements of the contract, like the existence of the subject matter, its characteristics, its price, or the ability to deliver it, are unknown, unclear, or highly speculative at the time the contract is made.
So it's about avoiding deals where one party might be unfairly deceived or disadvantaged due to hidden or unknown factors.
Precisely. It's a deeply rooted principle aimed at preventing exploitation and promoting justice, fairness, and transparency in financial dealings. The idea is to avoid contracts built on undue, unjustified uncertainty that could easily lead to disputes or significant harm, darar, for one or both parties. And in the digital age, with these new, volatile, and rapidly evolving assets like cryptocurrencies, the principle of Gharar becomes incredibly relevant because of the inherent unknowns and rapid shifts involved.
Okay, so where specifically does Gharar manifest in the crypto market, according to our sources? What are the main areas of concern?
The sources pinpoint several key areas where Gharar is seen as particularly prominent. The most obvious one is market volatility and extreme price fluctuations. We've touched on this already. The value of cryptocurrencies can swing wildly, sometimes dramatically within hours or even minutes.
Yeah, you see those charts, it's crazy sometimes.
Exactly. This creates significant uncertainty for investors. It makes it incredibly difficult to assess the true, stable value of the asset, and it fuels highly speculative trading behavior, which itself is problematic from an Islamic perspective. Macer, or gambling. Bitcoin's history, with its massive bull runs followed by equally dramatic crashes, is a prime example. Entering a contract based on a price that could collapse moments later introduces a huge element of uncertainty about the fairness of the exchange.
Volatility is a big one. What else?
Another major concern contributing to Gharar is the lack of comprehensive and consistent regulatory oversight. Unlike traditional financial markets, which are usually governed by established central authorities, strict laws, and investor protection mechanisms, the crypto space often operates in a decentralized and, in many jurisdictions, largely unregulated or ambiguously regulated manner.
A bit of a Wild West situation sometimes.
It can feel that way. This creates profound uncertainty regarding things like investor protection. What happens if an exchange gets hacked? The prevention of market manipulation like pump and dump schemes, and the overall stability and long-term legal standing of the crypto market itself. It means investors face significantly higher risks of fraud, hacking incidents where their funds can simply vanish, or sudden, unpredictable regulatory clampdowns in certain countries that can severely impact the value and usability of their assets, often with little or no recourse. This regulatory ambiguity is a major source of systemic Gharar.
Okay, volatility, lack of regulation. Any other specific examples?
Yes, initial coin offerings, or ICOs, are also specifically highlighted as often exhibiting significant elements of Gharar.
These are the fundraising things for new projects.
Exactly. Companies issue brand new, unproven tokens to raise funds, often based just on a white paper and promises. Investors in ICOs frequently face considerable uncertainty about the actual success and viability of these projects. They're typically in very early stages, often lack proven track records, clear business models, or any meaningful regulatory oversight.
Sounds risky.
Extremely. This environment of minimal due diligence and accountability in the early ICO market unfortunately led to numerous scams. projects raised millions from hopeful investors and then simply disappeared. Or the tokens they issued became utterly worthless because the underlying project failed or never even existed. This represents an extreme form of Gharar because the very existence, quality, and future value of the underlying good or service being promised are highly uncertain at the time you invest.
That really clarifies the risks. Now, you made an important distinction earlier between simple market volatility, which exists everywhere, and this deeper concept of Gharar, the inherent uncertainty in the transaction itself. Can you elaborate on that difference again? It seems key.
It is absolutely key, and getting this distinction right is crucial for a nuanced Sharia analysis. Volatility, simply put, just describes price movements. Assets go up, assets go down. Stocks are volatile, commodities are volatile, even real estate can be volatile. Buying shares in a promising but unproven tech startup involves high volatility because its future success is uncertain. However, the transaction of buying that stock is usually clear. You know how many shares you're buying, at what price, through a regulated broker, and what your rights are as a shareholder. The terms of the deal aren't typically ambiguous.
Okay, so volatility is about price risk, which is normal in investing.
Right. Gharar, on the other hand, describes a deeper, more fundamental ambiguity or uncertainty within the contract or the transaction itself. It's about the integrity and clarity of the deal. This ambiguity can stem from various sources: unclear terms and conditions, a fundamental lack of transparency about exactly what is being exchanged. Is this token just code or does it represent a real right? An absence of regulatory oversight that makes fraud or misrepresentation easier, or even an uncertain legal status of the asset itself, meaning its very classification as valid. Maul is questionable in a particular jurisdiction.
Can you give an example using crypto?
Sure, let's go back to Bitcoin. Bitcoin is undeniably highly volatile. Its price swings dramatically. However, you could argue that as the ecosystem matures, some of the Gharar concerns are lessening, even if volatility remains. For instance, as more reputable, regulated exchanges emerge, as clearer legal statuses are defined in major economies, even classifying it as property or a commodity for tax purposes, and as robust security practices become more standard, the uncertainty regarding its fundamental legal recognition or the risk of outright fraud in a basic buy-sell transaction might decrease.
So the transaction itself becomes less uncertain, even if the price is still unpredictable.
Potentially, yes. The inherent uncertainty of the transaction is reduced, even if the price volatility remains high. So from a Sharia perspective, a highly volatile asset isn't automatically forbidden due to Gharar, but a transaction involving that asset, which is itself ambiguous, opaque, or excessively risky, would be problematic due to Gharar.
That's a really helpful clarification. So for you, our listener, navigating this complex landscape, what practical steps can you take, according to the sources, to mitigate the Gharar associated with crypto investments?
The sources offer some very clear, actionable strategies, and interestingly, many of them align well with both general principles of sound financial management and the ethical spirit of Islamic investing, which emphasizes prudence and avoiding excessive risk. First, diversify your portfolio. This is standard advice, but it's especially vital in crypto. Don't put all your capital into one single coin, especially a lesser-known one. Spreading your investment across different, perhaps more established cryptocurrencies can help mitigate the risk if one particular asset crashes. It aligns with the Islamic principle of not putting all your eggs in one basket and avoiding over-reliance on speculation.
Makes sense. Spread the risk.
Second, conduct thorough research. Due diligence is absolutely crucial. Before investing anything, really dig deep. Research the project behind the coin, understand the team involved, scrutinize the underlying technology. Does it solve a real problem? Analyze the current market conditions and the token's specific utility or use case.
Go beyond the hype.
Absolutely. This isn't just about reading a flashy white paper. It means trying to understand the project's long-term viability and potential risks. This minimizes the jahala, ignorance aspect of Gharar. Making informed decisions reduces uncertainty.
Okay, diversify, research. What else?
Third, set clear investment goals and define your risk tolerance. Before you invest, decide why you're investing and how much you are realistically willing and able to potentially lose without causing financial hardship. This helps you avoid impulsive, emotionally driven decisions often fueled by FOMO, fear of missing out, or market hype. Islamic investment principles emphasize clarity of intention and purpose, not blind speculation. If you're risk-averse, maybe crypto only forms a tiny speculative part of your overall portfolio, if any.
Having a plan. Got it.
Fourth, consider using risk management tools like stop-loss orders. If you're trading on an exchange that offers them, this can be effective. You set a predetermined price at which your crypto will automatically be sold if the market drops significantly. This can limit potential losses during sudden crashes, providing a predefined exit strategy and reducing the financial uncertainty of a sharp downturn. It's a way to cap your downside risk.
That's a practical tool. Anything else?
Yes, a few more points. Stay updated. The crypto landscape changes incredibly fast. Keep abreast of market news, technological developments, and especially regulatory changes in your jurisdiction and globally. This helps you anticipate shifts and manage risks proactively. Also, seek regulatory compliance. Where possible, try to use platforms and invest in projects that adhere to known legal and ethical standards or operate within regulated frameworks. This provides a layer of accountability and reduces systemic Gharar. And finally, perhaps most importantly, seek professional advice. Talk to qualified financial advisors who understand both the crypto space and the principles of Islamic finance. Getting expert guidance tailored to your situation is invaluable. Taking these steps together won't eliminate all risk, but they can significantly reduce the element of Gharar for you as an individual investor, making your engagement with digital assets more structured, informed, and ethically sound.
That's very comprehensive advice. Now, is the market itself offering any solutions to this problem of volatility and Gharar?
Yes, and one of the most fascinating developments highlighted in the sources is the rise of stablecoins.
Ah, the coins pegged to things like the US dollar.
Exactly. These are a specific type of cryptocurrency designed precisely to maintain a stable value. They typically achieve this by being pegged, usually 1.1, to stable reserve assets. Most commonly, this is a major fiat currency, like the US dollar. Some are exploring pegs to commodities like gold or even baskets of other assets. The key purpose is to significantly reduce the price volatility that plagues traditional cryptocurrencies like Bitcoin or Ethereum.
So they aim to remove that big price swing risk.
Precisely. By minimizing volatility, they directly mitigate a major source of uncertainty and therefore Gharar associated with crypto transactions. Coins like Tether, USDT, and USD Coin, USDC, are prominent examples. They offer users a way to hold value on the blockchain or transact digitally without being exposed to those extreme price fluctuations. Now, they're not entirely risk-free. There can be risks associated with the issuer, the transparency of the reserves backing the peg, or the mechanism itself, but they represent a significant step towards achieving stability in the digital asset space, potentially aligning more closely with the Islamic ideal of predictable and stable value for transactional purposes.
Very interesting. Stablecoins is a potential answer to Gharar. Okay, let's shift gears slightly. Beyond the fundamental question of whether crypto is halal or haram and navigating Gharar, there's another major practical question for Muslim investors: Zakat. How does this apply?
Right. Zakat is the third pillar of Islam, an obligatory act of charity for eligible Muslims, purifying wealth and supporting the needy. So naturally, the question arises, do you have to pay Zakat on your crypto holdings? The sources, like the Capco article on crypto gains and the Zakat benefits, provide crucial clarity here. The general consensus emerging is that Zakat is indeed mandatory on crypto investments if they are purchased primarily with the intention of making financial gains or profits.
So if you're holding it as an investment, hoping the price goes up, Zakat applies.
Yes, that's the key criterion. The intention of growth or trade. If you buy crypto purely as an investment or for trading purposes, it's generally considered a Zakat-eligible asset. And importantly, Zakat isn't just applied against the profit you make, it's calculated on the full market value of your crypto holdings on your Zakat due date, much like how Zakat is levied on other productive liquid assets like cash, gold, silver, or stocks held for growth.
And the rate is the standard 2.5%.
Correct. The rate is 2.5% of the total value of those holdings. So using the example from the source, if you bought £5,000 worth of crypto and on your Zakat anniversary its market value is £6,000, your Zakat obligation would be 2.5% of the entire £6,000, which is £150. This approach essentially classifies investment crypto as a type of liquid, growing wealth, Maul, that should be purified through Zakat.
Okay, but does Zakat apply to everyone who holds crypto? What about the nisab threshold?
Excellent point. Zakat only becomes obligatory once your total Zakat-eligible wealth meets or exceeds a minimum threshold known as the nisab. The nisab isn't a fixed monetary amount. It's traditionally calculated based on the current market value of a specific weight of gold, usually 87.48 grams, or about 3 ounces, or silver, 612.36 grams. You'd use the value of one of these on the day your Zakat is due.
So it fluctuates with metal prices.
Yes. This a dynamic benchmark ensures Zakat remains relative to the actual value of wealth in the economy. So you need to calculate the current nisab value first. Then you add up all your Zakat-eligible assets, cash, savings, gold, silver, business inventory, stocks held for growth, and your investment crypto holdings. If your total net worth, after deducting immediate liabilities, meets or exceeds the nisab value, then zakat is obligatory on all those assets combined.
And when do you pay it?
Once your wealth first reaches the nisab, that day typically establishes your personal zakat anniversary or due date to Sakal. Zakat then becomes due 1 full lunar year later, calculated on the total eligible wealth you possess on that specific anniversary date each year.
That clarifies the threshold and timing. But you mentioned earlier that the type of crypto matters for its basic permissibility. Does the type of token also affect whether zakat is due on it? Is it a one-size-fits-all approach for zakat?
No, it's not one size fits all, and this is a really important nuance from the sources. The specific function and your intention behind holding a particular type of token significantly influence its zakat eligibility. So for cryptocurrencies like Bitcoin, Ethereum, and similar coins, the ones most people think of, often held as investments or traded for profit, zakat must generally be paid on the entire holdings value if nisab is met. This is because, as we discussed, they are primarily viewed as stores of value or speculative assets held with the intention of financial gain, and they are liquid. They fit the classic definition of zakat-eligible wealth.
Okay, standard cryptocurrencies. Zakat applies if held for investment. What about other types of tokens?
Then there are security tokens. These are digital assets designed to represent ownership in an underlying real-world asset, or venture maybe shares in a company, rights to revenue from a project, or even a fraction of a piece of real estate. The source mentions examples like BCAP, Blockchain Capital, or SIA Fund. For these security tokens, zakat is also generally applicable on their full market value on your zakat date. The reasoning is similar to how zakat applies to traditional stocks or shares held for investment. Their value is expected to grow with the success of the underlying venture, making them a form of productive, growing wealth subject to zakat at the 2.5% rate.
Okay, security tokens treated like shares. Makes sense. Are there any types where zakat doesn't apply?
Yes, and this is where utility tokens come in. These are treated quite differently. Utility tokens are specifically designed primarily for use within a particular blockchain application or ecosystem. They grant you access to a service, pay for internal transaction fees, or unlock features on a specific platform. Think of them more like digital vouchers, access keys, or software licenses. Examples given include Filecoin, used to pay for decentralized data storage, or the Swissborg token, CHSB, which might grant users lower trading fees or premium features within the Swissborg app.
So if you hold them just to use the service.
Exactly. If you acquire and hold utility tokens purely for their intended functional purpose, like buying Filecoin just to pay for storage you actually need, or holding CHSB solely to get platform benefits, then zakat is generally not applicable on those tokens. They're seen more like prepaid service credits or tools, not primarily as investments held for growth.
But what if you buy utility tokens hoping their price goes up so you can sell them later?
That's the crucial caveat highlighted in the source. If you acquire utility tokens not for their utility, but primarily with the intention of holding them as a speculative investment, hoping to resell them later on an exchange for a profit, then they generally become subject to zakat.
So the intention is key again.
Absolutely. Your intention, niyyah, transforms the token's classification for zakat purposes from a non-zakatable utility item into a zakatable investment asset. This nuanced approach really shows how Islamic finance looks at the substance and purpose behind an asset, not just its technical form, when determining zakat obligations.
That's incredibly helpful, clarifying zakat based on both intention and token type. Now let's zoom out a bit. We've talked a lot about the controversies around cryptocurrency assets.
Yeah.
But what about the underlying technology, blockchain itself? How is that viewed in Islamic finance? Is it less controversial?
Yes, that's an excellent observation and a critical distinction the sources make. While the assets built on blockchain, cryptocurrencies, remain points of significant debate, the underlying blockchain technology itself seems to garner much broader acceptance and even enthusiasm within the Islamic finance sphere. The Islamic Finance Guru article, for instance, broadly concludes that, as a concept, there's generally nothing problematic from an Islamic perspective about blockchain technology itself, or about seeking to profit from its legitimate uses.
So the ledger system is okay.
Pretty much. Blockchain, at its core, is seen as a distributed, immutable ledger technology. It's fundamentally viewed as a highly advanced 21st century format for accounting, record-keeping, and secure data management. Its ability to make processes cheaper, more transparent, and more efficient is widely recognized. The technology itself, with its decentralized nature, cryptographic security, and transparency features, is largely viewed as a neutral, potentially beneficial tool.
And other sources agree on this generally positive view of the tech itself.
Yes, the discussion on Islamic finance and cryptocurrency source reinforces this. It indicates that blockchain technology is likely to be accepted and even embraced in Islamic finance with one important condition, provided there is strict supervision and governance to ensure it's being used for permissible halal activities and not facilitating forbidden haram ones.
So the tool is fine, it just depends on how you use it.
Precisely. This acceptance is largely driven by blockchain's inherent potential to actually enhance compliance with core Sharia principles. Its ability to improve transparency, ensure accountability, and provide immutable traceability in transactions can actively help reduce ambiguity, Gharar, ensure clear records, vital for contracts, and increase trust between parties. So, rather than creating new ethical problems, the technology itself is seen as potentially solving existing ones, provided its implementation is carefully designed and managed to align with Islamic values and avoid prohibited elements like interest, riba, or excessive speculation, macer. It's about harnessing the efficiency and security of the ledger, separate from the often speculative nature of many crypto assets built upon it.
Okay, so the tech itself gets a thumbs up, generally. Where are we actually seeing blockchain being applied or explored in ways that specifically align with Islamic principles and could potentially revolutionize parts of the Islamic finance industry?
We're seeing significant potential and some emerging applications across several key areas. One of the most promising, as mentioned earlier, is smart contracts. Remember the self-executing contracts coded onto the blockchain?
Right, automating agreements.
Exactly. Their ability to offer high security, drastically reduce manual errors, and eliminate the need for certain intermediaries significantly enhances cost efficiency and speeds up processes. There were reports cited suggesting potential annual savings in the billions for banking and insurance just through blockchain applications, highlighting the scale of efficiency gains possible. Crucially, the inherent transparency, immutability, and automated execution of smart contracts align remarkably well with Islamic principles of fairness, clarity, wudu, and the strict fulfillment of contractual obligations, wafa bi al-had. They can effectively reduce potential disputes, niceties, and contractual gharar by embedding clear, predefined terms directly into transaction logic itself.
How might smart contracts be used specifically in Islamic finance products?
A prime example discussed in the sources is smart sukuk. Sukuk are Islamic financial certificates, often described as Islamic bonds, that represent ownership in a tangible asset, project, or venture structured to avoid interest.
Okay, Islamic bonds on the blockchain.
Precisely. Traditional sukuk issuance can be a complex, costly, and paper-intensive process involving multiple intermediaries. Blockchain, utilizing smart contracts, can potentially revolutionize this. It can drastically reduce issuance costs, automate profit distribution payments to sukuk holders, and provide much greater transparency and traceability for investors regarding the underlying assets. This could make sukuk more accessible, efficient, and attractive for both issuers seeking Sharia-compliant funding and investors looking for ethical investment opportunities, potentially democratizing access to Islamic capital markets.
That sounds transformative for Sukuk. What about areas like charity or social finance?
Absolutely. Blockchain also holds huge potential for improving Zakat and Waqf management. Waqf refers to Islamic charitable endowments, often property or assets dedicated to social welfare purposes.
How can blockchain help there?
Its transparent and immutable ledger can dramatically improve efficiency and accountability. Imagine tracking Zakat donations from donor to final beneficiary with complete transparency, ensuring funds reach those intended. Or managing Waqf assets and distributing their proceeds more efficiently and with less risk of mismanagement or corruption. This directly aligns with the core ethical mandate of Zakat and Waqf to serve the community justly and effectively, enhancing trust in charitable institutions.
And what about the cutting edge, like DeFi? Is there an Islamic angle there?
Yes, there's significant interest in exploring Islamic decentralized finance, DeFi. The idea is to leverage blockchain's transparency and decentralization to build financial applications that are inherently more equitable and accessible. Proponents argue that blockchain-based DeFi could potentially reduce opportunities for corruption, money laundering, and other illicit activities often associated with opaque traditional systems. It could also ensure more equitable, permissionless access to financial participation for a wider segment of the population, particularly in underserved regions, aligning with the goals of Islamic finance to foster inclusive and just economic systems.
But wouldn't DeFi platforms need careful checking for Sharia compliance? Many involve lending, borrowing, liquidity pools.
Absolutely critical point. Any Islamic DeFi platform would need rigorous Sharia screening and structuring. The underlying protocols and smart contracts would have to be meticulously designed to ensure they are completely free from riba interest, excessive Gharar, prohibited forms of speculation, maisir, and investment in forbidden industries. It's a complex challenge, but the potential to build inherently more ethical financial systems is a powerful motivator for research in this space.
So you're seeing blockchain potentially impacting everything from bonds to charity to DeFi. Now, what about the role of governments and central banks? We hear a lot about central bank digital currencies, CBDCs. Is there discussion about specifically Islamic CBDCs?
Yes, there is, and it's a truly significant area of exploration, potentially reshaping national monetary systems from an Islamic perspective. One of the sources highlights an intriguing academic study proposing an Islamic central bank digital currency, CBDC design. The core idea isn't just to create a digital version of the national fiat currency, but to design a digital currency infrastructure that is inherently aligned with Islamic principles from the ground up.
How so? What would be the goals?
The stated objectives are to achieve maslaha, which means promoting public interest and welfare, and to actively mitigate mudhara, meaning harm or negative consequences. So it's about embedding ethical considerations like fairness, risk sharing, and socioeconomic justice into the very architecture of the nation's digital currency.
That's ambitious. Does the study look at the practicalities, the pros and cons?
It does. The source mentions a SWOT analysis, strengths, weaknesses, opportunities, and threats, which gives a balanced view. For strengths, an Islamic CBDC could significantly foster digital financial inclusion, providing direct access to central bank money for citizens who might be unbanked or excluded from the traditional system. It could potentially offer better resilience to disruptions like power outages or bank failures, if designed correctly, for example with offline capability. And it could mitigate some risks of bank disintermediation, people pulling all money out of commercial banks, by offering a direct, safe, digital alternative.
Okay, those sound like strong potential benefits. What about the downsides?
The weaknesses identified are significant hurdles. Designing and implementing such a system involves immense technical complexity. There's currently an underdeveloped legal and regulatory framework globally for CBDCs in general, let alone one specifically designed around Islamic principles that would require extensive groundwork. And naturally, there are very high initial investment costs for the necessary technology and infrastructure.
And the external factors,
Yep.
opportunities and threats.
On the opportunity side, the analysis points to the rapidly growing global Islamic finance sector, which provides a potentially large and receptive user base. The broader societal shift towards cashless payments and digital economies also creates momentum. And there's the potential for positive network effects as more people and businesses adopt it. Its utility increases for everyone. But there are also significant threats. Cybercrime is a constant danger for any digital currency system, requiring state-of-the-art security measures. Low levels of digital financial literacy among parts of the population could hinder adoption or make users vulnerable to scams. And crucially, an Islamic CBDC would face intense competition from existing conventional alternatives, both traditional fiat money and payment systems, and potentially popular private cryptocurrencies or stablecoins.
That SWOT analysis really paints a clear picture of the complex landscape facing Islamic CBDCs, huge potential for ethical impact, but formidable practical and competitive challenges.
Absolutely. It underscores that the entire discussion around Islamic finance and cryptocurrency, including CBDCs, is far from settled. It's a dynamic field with continuous evolution. Our sources show research is vigorously ongoing across the board, further exploring blockchain adoption in Islamic banking, refining the rules for digital currency transactions under Islamic law, assessing the potential and pitfalls of new Islamic crypto ventures, and deepening the legal analysis under Sharia principles.
Are there specific types of crypto innovation being watched closely?
Yes, for example, the sources mention ongoing exploration into precious metal-backed cryptocurrencies, PMBCs. These could directly address the lack of intrinsic value concern raised by some scholars by tying the digital token's value directly to reserves of physical gold or silver. That's a very compelling proposition for stability and Sharia compliance. And fundamentally, given the undeniable growth in the number of Muslims participating in the crypto market worldwide, there's an increasing recognition of the urgent need for more genuinely Sharia-compliant products, platforms, and robust oversight mechanisms within the Islamic finance industry itself. This means moving beyond just asking, is Bitcoin halal, towards proactively developing and offering digital assets, investment funds, and financial services that are not just permissible by default, but are actively designed from the outset to embody Islamic ethical principles, ensuring Muslims can participate in the digital economy in a way that aligns with their values. It's a call for innovation guided by principle.
What a truly comprehensive journey through this complex intersection. We've covered so much ground today. We started with the fundamentals, what cryptocurrency is, its key traits like decentralization and transparency. We explored the deep Islamic legal debate around Maul, asset versus currency status, hearing the differing views of prominent scholars. We dove into the critical concept of Gharar or uncertainty, understanding its sources in crypto, and, importantly, how you as an investor can take practical steps to mitigate those risks. Then we clarified the rules around Zakat on crypto gains, noting the importance of intention and token type. And finally, look beyond crypto assets to the broader potential of blockchain technology in revolutionizing Islamic finance, from smart sukuk and charity management to the ambitious future possibility of Islamic central bank digital currencies.
It's certainly a lot to take in. And what emerges clearly is that while the underlying blockchain technology holds immense promise and is largely viewed favorably for its potential to enhance transparency and efficiency, the Sharia status of specific cryptocurrencies remains a deeply complex and evolving issue. The debate is driven by very real concerns about volatility, the philosophical question of intrinsic versus assigned value, and the ongoing challenges of regulatory uncertainty and oversight. So, the key takeaway for you, our listener, really has to be the absolute necessity of diligent personal research, seeking knowledge from reliable sources, understanding the different scholarly perspectives, and applying core Islamic ethical principles like avoiding excessive risk and speculation when engaging with the space. Informed decision-making is paramount.
Absolutely. And as this digital transformation of finance accelerates, it leaves us with a powerful question to ponder. If the future of money increasingly lies in digital forms, how will Islamic finance continue to innovate and adapt? How can it create truly Sharia-compliant solutions that not only uphold its timeless principles of justice, fairness, and risk-sharing, but also effectively harness the power of these new technologies, their efficiency, transparency, and global reach for the genuine benefit of the global Muslim community and perhaps beyond? What implications do you think this ongoing integration of technology and Islamic finance has for global financial inclusivity, particularly for the billions who remain underserved by today's conventional systems? Lots to think about there. Thank you so much for joining us on this deep dive. We sincerely hope this exploration has given you a clearer, more informed, and perhaps even more engaged perspective on this rapidly changing and incredibly important landscape. Stay curious, keep learning, keep asking questions, and we'll be back soon with another deep dive into your sources. Until then, take care.